Federal Reserve recently raised the benchmark federal funds rate to between 5.25% and 5.5%, a 22-year high. Despite the Fed pushing interest rates higher since early 2022, the economy has continued to grow over the past year at over a 2% pace, following a slight contraction through the first 2 quarters of last year. Most recently, the U.S. gross domestic product grew at a rate of 2.4% through the second quarter of 2023, beating expectations of only a 2% growth rate. So far, the economy has remained resilient, but there are signs of cooling. Consumer spending has slowed over the course of the second quarter, growing at a rate of 1.6% versus the first quarter growth rate of 4.1%. This will likely continue through the rest of 2023 as consumers will continue to battle the effects of higher interest rates, and student loan repayments starting again will likely decrease the amount of funds consumers will have available to spend. Additionally, job openings declined by 34,000 to a seasonally adjusted 9.6 million in June from the prior month, the lowest level since April 2021, showing that the gap between job openings and people looking for work continues to shrink. The numbers show that the labor market is gradually cooling, but still remains strong over a year after the Fed began lifting interest rates to slow the economy and combat high inflation. The fall in demand for workers that doesn't drive unemployment significantly higher is what the Federal Reserve is aiming for, and so far have been able to accomplish with the unemployment rate currently sitting at near historical lows at 3.5%. As we've seen so far, the economy's continued resilience along with the downward trend of inflation over the past year has led to the increased optimism that the Federal Reserve will be able to achieve their soft landing goal of taming inflation while not completely stifling the labor market.